Welcome to Value Investing webinar once again. A lot has happened since the last webinar. The election results are out. As expected, we have a stable government, reasonable continuity, and the market has been behaving. In fact, behaving in a nice way, going up. But before that, it was behaving erratically, slipping down gradually. What is in store for us? What to expect from the market? Where the opportunity lies, and where are the landmines? Once again, with me here is Sorbh Gupta from Quantum Asset Management. Welcome, Sorbh.
Thank you.
So, same questions once again. Where are we? How does the valuation look now?
Look, you cannot generalize in the sense that if you talk about the index Sensex per se looks very, very expensive. It's essentially at a life high in terms of P multiple at 29 times. But there are opportunities in the broader markets. Even within the index, being a narrow index, it's driven by 3 or 4 stocks which are getting overvalued from more and more. So essentially a narrow index getting narrower in terms of performance, but broader market, yes, you have opportunities to invest. There are some pockets where you are getting stocks below fair value. So yes, so broader market is giving you enough opportunities.
So you are not much disappointed by the headline number of price earning ratio of the Sensex or the Nifty as such?
No, not really. So if you drill or go beyond the headline numbers, if you look at top 5 stock, if you remove their performance, and these are the high weight ones, rest of the index has actually not done that well, and they are reasonably priced also. So you need to go beyond the top 5 stocks in the index, and even if you go beyond the index, beyond the benchmark index, there are enough opportunities, I believe.
But we've seen, last 2-3 years, the earning is not growing, it's not going up. And that is the primary driver for, a stock performance, fundamentally, looking at things. So when do you think, what will be the key drivers which will actually propel or, drive the earnings once again?
Yes, so earlier, if you look at it this way, that the private capex never picked up in India. Since 2015, there were only talks. The government capex did pick up, but the private capex were really lacking. But there was consumption demand driven by maybe leverage or funding by NBFCs. But somehow there was a consumption-driven economy which was moving up. But of last 3-4 months, 5 months, post the island FS and some liquidity crunch that has happened on NBFC side, we have seen consumption demand also slow down.
Okay.
Yeah. So that's the situation on the macro side.
So that is unlikely to drive earnings anyway.
Yes.
Even the core consumption which we have seen very resilient.
Yes, you're right. So cyclically, maybe we are at a little tough times in terms of macro, but then that gives us opportunities also in terms of valuations.
But the damn market doesn't go down; it always goes up.
Yeah, you're right. But only in terms of benchmark.
Any bad news and in market doesn't slip substantially.
From benchmark perspective, you're absolutely right. But yes, post October, if you see, there have been pockets and sectors we have reacted to bad news, and there have been opportunities there. So I believe that it's a patient man's game. You have to wait for your price, and then maybe you get opportunities. But last 6 months we have got more opportunities than maybe a year before that.
Okay.
That would be a right statement.
Yeah, of course. 2017 was a tough year,
right,
and 2018 started slipping. So you would not have got any opportunity in 2017.
Absolutely.
But where are you finding opportunity in terms of sectors?
So sectors, we are finding opportunities in, say, cement. Cement was way out of reach for a value investor for quite some time. But if you look at from October onwards, the prices have come down for many of the stocks, even the larger ones. So we found new opportunities there. That was one. Second, we are finding opportunities in the NBFCs. It looks like a contrarian call, but what happens is that when there is a bad news in a sector and everything falls, some strong names also fall in terms of valuation, because market is hitting everywhere, every one of them. But that's where your homework comes to play, and you can find out good names which eventually will recover because they have a sound business model at place. So that's the second opportunity that we are looking at. And thirdly, auto also looks very attractive, though it's a cyclical downtick for most auto companies. But we believe that the macro long long-term macro opportunities for macro two-wheelers, three-wheelers, four-wheelers is extremely strong in India. So you're getting companies at a very attractive valuation. They have strong balance sheets. The ROEs are still very attractive. We believe the opportunity lies in two-wheelers and four-wheelers as well.
You're talking about these, specific companies within a sector. These are sectors which you find opportunities there. But if you have to choose, I'm not looking for a name. But what will be the framework, assuming that you have to choose a cement company of the 10 or 6 big players that we have? How will you go about it?
Look, so I essentially look for companies which are more pan-India, so that reduces risk. Cement being a regional game, pan-India player with low cost of production, wherein it can match if the prices go down, still it remains profitable. That is second. A very strong balance sheet always helps. Ability to generate cash and strong corporate governance. So these filters, and then we look at valuations. If we are getting at 40-50% discount to the fair value, we'll go ahead and buy it.
How about NBFC? It could be a landmine. Things blow up when you least expect it.
Yes, you're right. So
it's such a leveraged business 10 times, and it takes so little to disappear.
Yeah, you're right. But over the period we have seen that some managements do better job in terms of managing those risks. So the lending business is all about underwriting risk and managing your balance sheet, liability side, that is, because NBFCs are wholesale funded.
The kind of bad news we are getting, it could blowing up. We never expected that they're such concealed, opaque businesses.
Yeah, you're right. Because if you go back in history, they all gave signals about the rate of growth that they were growing. That is the first signal. So because in a lending business, growing is the easiest thing that you can do. How you manage your liability side and how you underwrite the risk is the most important. So if you have done your research well and look at companies who have survived over cycle, those companies who have managed their ALM and not run after growth because they were getting money cheap, those are the companies will survive again. You are getting them at good valuations, and we believe when the things are better, they will give you returns.
So that is the primary, their experience, their maturity, and their existence in full cycle, market cycle.
Sure.
What are you finding untouchable today for their valuation? Too scared to buy? Can't buy at all?
The first name are consumer staples.
Okay.
And they've not been in the portfolio for quite some time, and the valuations are just too prohibitive, and they're not reacting to bad news, as you rightly said.
They just don't go down.
Yeah, they just don't go down. Even the bad mid-cap names or largest player or players smaller than that, even if they disappoint, they don't go down, and the valuations is too prohibitive.
So what is your priority? You've said about the where lies the opportunity, but and you're still sitting on cash. You still have meaningful, 15%?
About 14, yeah.
15% cash. So if you have to allocate that tomorrow or deploy it, what will you do?
Look, so we don't go by deploying cash whenever we'll see the opportunities. As of now, we are not finding opportunities. We have found opportunities till 85-86% of the portfolio. We have bought into that, but we are waiting for some good names. If they're correct, we'll go ahead and buy those. So we are not going by how to deploy our cash kind of approach. It's not a cash call, it's a bottom-up approach, and if some good names in this fall further comes to our buy, we'll go ahead and...
So how long is your watch list right now? While you're waiting for
we have a universe,
some accidental correction?
We have a universe of good, strong, researched universe of about 220 stocks.
No, but what will be on your buy watch list that slip by 15% and you'll
so
get cracking?
I think there could be at least 5 names who would be below 15% buy, very close to 15% buy, 3 to 4 names, and there would be a bad day or a bad week, we could get into those names.
So thank you very much for your thoughts, and we'll get cracking on some questions. Very interesting question. Now we have started getting for value investing webinar, which is not very bare basement level. Dhirendra has this question, and I think it's just meant for you to answer. How do you identify the below points while researching about a stock, a bogus company, bad corporate governance, cooked book of accounts, and credibility of the management and auditor? All these things are so much in the news. They are hitting headlines.
Right. So how do we go about it?
How do you spot a bogus company? Let's go point by point. It's a very interesting question.
So bogus companies, definitely first level of research is what does the company do, in the sense that is there an opportunity which the company says there is an opportunity, that is one. But once you read the annual report, first filter is their ability to generate cash. So that is one of the key points. That's number one. So what happens often that the company shows a strong revenue growth and an EBITDA growth, but if you look at cash flows, all the cash is going into receivables. So the company is not generating cash. So
They are not unable to realize it.
yeah, so there is one indication that he might be booking revenues without actual sales. So that is one key indicator. Second is he paying taxes? And by tax, not the P&L tax, because now P&L tax is an accrual item. You have to go to the cash flow statement and see whether the company is paying tax, actually paying cash tax. So this means that he is showing revenues in the income tax accounts as well. Third is, does he pay dividend? That is third. And history also tells a lot of things. So because we have seen companies and promoters and founders who every cycle change their names to the attractive theme and then come to the market, raise capital. So over history, over experience also helps us to understand whether this company is doing something genuine or not. So these are the things that you need to keep in mind.
Do you really look for credibility of the management and auditor? Do you really see that, a big four auditing it or not a big four auditing it, does it make a difference?
No, we do, as of now, the way things are, we don't think so, because the way Satyam had a big four, and ILNFS had a big four. So these names do not sign credit, they don't matter. But yes, SEBI of late has come out with some regulations about when to churn the auditor and stuff like that. And you could check whether the auditor is getting some other payments as well. Besides the statutory fees, is he as a consultant also getting some fees?
Eliminating conflict of interest, those getting reported.
Yeah, and is there an internal audit different from a statutory audit? So these are the things that you can keep a tab on.
Okay, I'll just add one more thing, which is, I was just looking at a story in our Wealth Insight magazine, this issue, that from this financial year, it has been made mandatory that the auditor's discussion will be mandatory. So what used to be just a signature that, the auditor will take underwriting from the promoters or the management, that and he will just give a statement that it is true to best of his knowledge and understanding. Right. No longer. He's supposed to certify, he's supposed to give a discussion, and that auditor's note which will be upfront. So what I'm finding is that this year's annual report is going to be very interesting. Every audit. So, Dhirendra, you can start looking at the auditor's note at the start of an annual report to figure out things better, and now they have skin in business. Now they can't say that we got this statement from the management and based on which they have done it. They are supposed to do some diligence. So now the government has brought about some skin in the business, in the sense that they are signing it. They should mean it.
Sure. Right.
They should do some diligence, some exercise of validating things.
Absolutely.
Now this is one question, and I would like to know, how do you do it? What is a multi-bagger? So multi-bagger is a stock which goes up multiple times, but how do you find one? And how can you spot such stock at an early stage?
Look, so
tell me one example of you found one and how did you do it?
Look, so how you did that? Yeah, so instead of
a stock which went by 5 times.
So within our portfolio, we have companies, and these are not early stage investments which have gone 5 times. Okay. So the idea of investing early stage and taking more risks, I think, is over exaggerated. Even the known names, good companies, and you can see that the opportunity size and the ability of the execution of the management shows that the company's revenue can grow at 15%, 15%, and they have stable margins. If you buy at good prices below fair value, this can be compounders as well. Even so
that takes 6 years to double.
Yeah, 15%, 4.5 years you can double your money. So in 10 years it's like more than 5 times. So that's good enough with the kind of risk that you are taking.
It's much more than good enough, because what we find is that Sensex has gone up from 20,000 to 40,000 in the last 10 years.
Right. So our belief is that early stage investing or any niche kind of investing, okay, it can pay off, but if you adjust risk to that, even the well-known names can do really well. In our portfolio, some really good. So the largest of the software companies, we hold it for many years, and it's done much better than a lot of mid-cap IT companies.
Okay.
Yeah. So that's the idea. So good businesses at good prices will make you.
So the whole thing that too big to grow rapidly may not be true.
I've seen companies defy scale and grow much faster than smaller companies.
Okay.
Yeah.
They have they have advantages which they can derive
Yeah,
from.
scale itself brings some advantages, right? So we should not ignore that.
Okay. Satyendra has this question that how can a normal investor identify the euphoria type of situation in Nifty or Sensex? What should he do? How to avoid euphoria?
Look, so two or three things. One is definitely if you have an understanding of P multiple, that helps, right? But you have to go beyond what's driving that P multiple.
No, but current P multiple of this market, and it is quite misleading in a sense that 4 companies driving that P which have the largest weight, and everybody thinks that market is expensive.
Yeah, so that's the point, that you have to see that whether it's driven by a few names, if you can find out, and if it's broad based, which is expensive. So every index, even the mid cap, the small caps, the sectoral indexes, are they expensive? So that's one of the things. And secondly, when everyone is talking about, so there's a famous saying that if your watchman starts to talk about equity markets, it's time to sell, right? So these are some intuitive feelings that you can get.
Or
that
the newspaper headlines is actually on stock market.
Yeah, so if the newspaper headlines on Sensex move from Economic Times to Times of India, maybe, so that could be an indicator that there is an euphoria. Be careful.
So what should he do?
So if it's an euphoria, better to wait.
So you don't find euphoria right now?
At the index level, yes. But as I told you, if you...
Markets in general, they are not in a euphoria.
I don't think so.
Okay.
Yeah.
Manoj has this very basic question. Should a retail investor get into stock options, and why?
So by stock options, you mean FNO options, put options and call options. So I believe this is a separate science, and it's not that easy to calculate the time value, intrinsic value and fair value, and it expires every month. So it's a different level of research. You need to do your homework. All these are complicated models.
You are being very polite. No, I need to really instruct Manoj differently. Future and option is a very dangerous thing for an individual investor who don't know the tricks. And these derivatives were devised as a risk management tool, but they help you speculate big time. With a small amount of money, you can take a big position, but these contracts expire every month. So if a wild movement takes place in the market, it is like a leverage play. It is like a leverage play. You put 1 rupee and you are riding a position of 10 rupee. So if the position becomes 11 rupee, it will look like you have gained 100%. But if that position slips by 10%, you will lose all your capital. You will lose 100%. So it's a very dangerous thing. Keep off from that. The only thing which works in the market is finding stocks which you understand, finding them at reasonable value, and waiting it with that. Maybe holding it for many years, and it works out nicely. So forget that. It'll look like easy money or opportunity making, easy way to make money. Don't fall for that, and you end up just paying brokerage and lose your capital. So keep off from that, Manoj. Pulkit has this question: how can I limit the size of my stock portfolio while also adding any new potential stocks?
This is rather simple. You have to sell something.
How can I limit the size of my stock portfolio while also, yes. So maybe, two things of doing it, 2 ways of doing it, which is, something which has become expensive, prune that position.
Yeah.
How will you go about doing it? Assuming that, you have finite amount of money, right, and you want to buy some compelling opportunity. So what are the approach that you'll follow?
Yeah, so there are 2 things. One is selling the expensive first. Secondly, if you can review your portfolio in the sense that what is a better stock to own, both in terms of ability to generate
reprioritize things.
Yeah, reprioritize things. And in a portfolio approach, that also helps. So sometimes it happens that the stocks have fallen and you own something in the portfolio, but you have a more attractive, better business and at a better valuations outside. So you can bring that in and trim some of the current holding, or you can exit which are potentially not that great name.
So basically, an opportunity to review your portfolio, reprioritize things, and reframe things. Okay. Rajesh has this question which only you can answer because you might be attempting some. How should I buy stocks when the market seems like a falling knife? Do you do it quite often?
Yes, we do. That's where the
and how often you succeed?
most of the time.
Okay.
Yeah, but then there are two things. One, your homework should be absolutely watertight so that you don't fear when it falls further. That
You
is,
understand what's going on.
yeah, what you are trying to get into in terms of one business and everything, and whether company's balance sheet and other things are strong enough to survive that cycle. That gives you a conviction. Your homework gives you the conviction. And secondly, you have to be very careful in the sense that you cannot catch the bottom, that's for sure. So you must be ready for next 10% also.
Okay.
So if you're buying at 100, there is always a possibility in the near term the stock could go to 90, right? Or
So
maybe
catching
85.
absolute low is impossible.
Yeah. So maybe you can start.
But is it only 10%?
It can be higher because in the near term market will react to how the majority is thinking. Everybody is selling, the short term hedge fund is selling, the markets will go down. Over longer periods of time, the stock will arrive to its intrinsic value. Yeah. So you have to be careful on both those two things.
Understand and have some price in mind.
Yeah, price
Around
in
which-
mind and wait along, because you might feel in the near term that you're going wrong, and you should not allocate your capital right at that point in time, 100% of your capital.
Okay,
Maybe
so stagger your investment,
yeah.
have some price band in mind, and don't get disheartened if it falls further. So, okay. So, this is Anil. Should we overlook growth stocks simply because they are overvalued? What should be the formula to choose a middle path?
Look, so there is a middle path in the sense of growth at reasonable prices, and these are different strategies. But yeah, growth investing is a slightly more risky investing than value investing. So our approach has always been take care of the risk first and protect your capital first, and then get for capital returns. So my suggestion would be stick to valuations a little more. Don't overpay for anything. That's the idea.
So, this is not an answer for Anil. I would suggest him a simple thing. Buy one growth fund and buy a value fund. And you'll be able to spread your money over the skills of two fund manager and buy a fund with over 10-year history of beating the benchmark with a growth strategy as well as a value strategy. So, you'll be able to do well all the time in the market, hopefully. Madan has this question: what should be the duration of an ideal long-term investment in stocks? How should I select stock for the same? So it's back to basics again.
Yeah, so not stock specific, but equity investing itself entails long-term investing. So essentially, less than 5 years should not be buying. It's plus 5 years, that's one. And if you want stock specific, look at the opportunity size and the company's ability to continue to grow at longer periods of time. How long can it sustain that kind of growth? So that's the second thing. And the management's ability to, and keep reviewing it, whether it's on track, whether the business, because the external environment is also getting very, very dynamic with these kind of startups and new technologies and disruption coming. Being a value long-term investor helps, but you need to keep on reviewing the business case of the business and just hang along.
Can you really cite me an example where you invested in a business with a long-term view, but the business turned obsolete in your investing lifetime itself?
Yes, we did. It was not that the business went bad, but what happened was that the company took some risk which did not pay off, and those risks started to reflect on the balance sheet. And it's the balance sheet, when the balance sheet starts to get worsened, that's the time when we definitely review the portfolio, because it's the balance sheet which will ensure that the company survives over longer periods of time. So P&L, okay, it's cyclical thing, but if that starts to reflect in a bad balance sheet in terms of debt equity and other things going bad, or very high goodwill on the books and acquisitions which are not too great, then we tend to start to go nervous.
Nirmal is asking this question: how relevant is the entry timing for an SIP in value fund for 10 plus years?
Look, I think you would be a better person to answer this one.
Yes, I would say that, don't try to time it. The whole idea of SIP is that, it fits in with your income cycle. It fits in with your spending cycle. You get your salary every month. You pay your home loan EMI every month. So invest every month. Then coming to value fund, I think the value fund, you don't need to do SIP. Assuming that you get sometimes, if you're doing a SIP of 10,000 rupee and once in a while you get 50,000 rupee bonus, you can well invest it, because the value fund manager is taking care of that. He's himself, some fund managers take a cash position. So the whole idea of SIP, even if you have lump sum money, is to eliminate the possibility of catching a market high. Eliminating the possibility of catching a market high is guarded in two manner in a value fund. You don't need to as strongly. One is that the value fund manager himself is focused on buying relatively cheap stuff. The other is that they are also taking a cash bet. If they find the market very expensive, then his investment time investment universe is, he finds that it has potential to fall further, they will have 10%, 20%, 25% cash. But never dilute this whole thinking on SIP. It's a good habit. Maybe all you should think in terms that you are able to, most of us actually are guilty of thinking of SIP in a constant number. Most people say that I've been doing SIP for 8,000 rupee for last 10 years. But in the last 10 years, your earning would have gone up. 8,000 rupee 10 years ago was very different from 8,000 rupee today. So as your income grows, increase your investments too. And most of the things, 10 years time frame where most of the things get taken care of automatically. Even if you hit upon a bad fund manager, you will end up doing well. So this should be a non-negotiable rule for most investors. Now Jaydeep has this question. What is the best and the easiest way to calculate the intrinsic value of stock? So I can tell you, Jaydeep, that there are many ways, but none of it is easy. You tell me how to do it.
Yeah, you are absolutely right. There are no easy ways or shortcuts to arrive at an intrinsic value of the stocks. It's a detailed work and it's not so easy to arrive. That is one. And about the best, in the sense that not every way of valuing or the intrinsic value of stock works for every sector or a company. So each sector or company will ask for a different way of doing things. In some of the cases, it could be replacement. For cement, it could be replacement would be a better thumb rule kind of work. Then some would be P, some would be cash flows. But yeah, these are not the easier ones, and you have to do a lot of homework in terms of what the peer, in terms of understanding the peer set, understanding the sector. Then maybe you have to devise the cash flows. So these are not easy things. These are full-time jobs.
Jaydeep, let me just add a little bit more to what Sorbh just said, that calculating intrinsic value of bond is pretty straightforward. You know that when you will get the money back, how much will you get in between, and what is the likelihood of getting that money, the probability of getting it or not getting it. And based on this, you can safely arrive at something which will work in a fairly narrow range, because they expire. A bond will mature in a defined time frame. So you can put it in an Excel formula, the cash flow from that bond till its existence. In case of stocks, it's complex. He can do his intrinsic valuation, I can do my intrinsic valuation, and we can have two different assumptions. I would think that this company will go ballistic, and he will think that this company will do well, but it will not go ballistic. I will think that it will go ballistic and it will go global. And he will say that it will grow well, but it will not go beyond the borders or at most South Asia. So our assumptions could, and I can have very strong belief in my understanding. He may have reasonable belief in his understanding, but because of his experience, he might be a little apprehensive about the ability of the management to do it. All these things, these are subjective things which will contribute to the intrinsic value, and it is in the eyes of the beholder. So don't get very stingy about it. You work on the worst case scenario and do some valuation that what will be 5 years, the cash flow and the growth and a moderate market context and how this company will look like. If this company looks 2 times bigger than what it is today based on those assumptions, I think it will be, then you just wait for your price. So this is the kind. Have I been able to summarize it?
Yeah. Broadly, this should work for him. And buying it below the fair value is extremely important to build your margin of safety, because it's a dynamic world. And Dhirendra said that there could be 2 or 3 intrinsic values depending on
my
the person.
primary thing was that I'm trying to emphasize that there is no formula. Absolutely. There is no precise formula. Unlike a bond valuation thing, even in bond valuation, we are finding that we are getting surprises on the rating, which is an opinion on the credit worthiness of a company. So quite a few interesting questions, Sorbh, and thank you for answering them in a fairly explanatory manner.
Thank you.
So see you again next value investing webinar, and hope you enjoyed getting answer to all your questions.